morning, everyone. Welcome to our Wednesday morning trading session. My name is Eric Senft. I'm going to be your host here this morning. Just a moment while I get the screen share going on. For those of you new to the Indicator Warehouse trade room, welcome. Let me give you a very quick overview of what you're looking at here, and then we're going to start looking at some of the markets. This is the diversified trading system, and it's diversified because we're looking at the market from 3 different points of view. Here across the top, I have my Hawk micro scalper. Through the middle here, I have the Falcon Swing Trader, and across the bottom is the Eagle Trend Trader. So as the name suggests, top tools for scalping, middle tool for swing trading, bottom tool for trending. The charts on the left are the NASDAQ. The charts on the right are crude oil. I'm also watching soybeans and the mini Dow on my other monitor, but feel free to ask for any market that you're interested in. Regardless of the tool, the signals all develop the same way. First, when a signal is getting ready, we're going to get a warning dot along with an audio alert. When the signal is complete, we're going to get a triangle and a hash mark. That tells us we have a signal that's ready to trade. Now, not all signals are created equal. We're going to be focusing more on high probability signals. For instance, here on the Hawk Scalper, this one right here, we refer to as the first micro-macro cross. Very, very high probability signal. You can see it has some nice follow-through there. We also have, here's another high probability signal. We refer to this as the macro pullback signal. For the most part, we're looking for signals where everything is in sync. There are a couple exceptions that I'll point out, but generally speaking, we're looking for the bars to be in sync, the filter to be in sync, the trend lines to be in sync, and of course, for the signal to be in sync as well. So here's the NASDAQ, just opened up this morning. And it looks like we had a little bit of an open gap. So the market left off down here near 4,800 yesterday. Nice steady rally through the overnight, and now we're opening up about 20 points higher. That's a pretty significant gap on the NASDAQ. It'd be interesting to see whether the market tries to get into that gap to fill it, or whether it's just going to continue rallying from there. No clear signal just yet. This is on our Eagle. We're coming down now to the hard edge of our trading band. No, this is not an Ichimoku cloud. Yes, I know it looks like one, but it's not. But similar to an Ichimoku cloud, when we encounter the hard edge here, we're anticipating some sort of reaction. Good question. Lee asks, is Apple causing that, the rally? It could be. For a while, the NASDAQ's nickname was Appleback. Because it would, of course, the NASDAQ would follow Apple stocks around like a puppy dog. While we're waiting for something there, it looks like the crude oil market also a little conflicted this morning. Here's crude oil on the Hawk Scalper, and you can see again very, very sideways. When we're printing a lot of yellow bars on the Hawk Scalper, that's a sign of neutrality. The market really doesn't have any bias here. Maybe just a slight downward bias. And I say that because we're producing a green bar sell, which is actually a sell signal. And we had a first micro-macro cross down here, which I don't believe hit its profit objective. And I know this to be a very high probability signal, so I would anticipate maybe the market would head a little bit lower. Of course, it is crude inventory day today. And what that means is that crude may end up going sideways for most of the session. Lee asked, can we take a look at Apple stocks? Let me see if I can get Apple in my data feed. Thanks, Alish. Alish reminding me it's FOMC day today. What time is the announcement out? Do we know? What's with that? Why am I not getting Apple anymore? Well, for some reason, I'm not getting Apple in my data assortment. What's with that? Okay, well, I'm going to have to horse around with that later. New data provider. So, of course, your data mix changes a little bit. All right, Tad says no sound. All right, I'm assuming because nobody else is asking about sound that it's on Tad's end, so I'm just going to send him a quick note. Okay. All right, so we're just going to give them a few minutes to settle in. Tom is asking which screen is the Raptor. I actually don't have the Raptor up here this morning, Tom. I'm just showing the main DTS tools. If you like, you can email Adam directly, and I'll give you Adam's email. And while I think about, speaking of Adam, Adam and I are going to be doing a presentation tomorrow, and I'll include the link for that in the room. If anybody's interested, we're going to be doing it just after the market close tomorrow. If you'd like to sit in for, it's only an hour-long presentation, and hopefully you'll get something useful out of it. Well, if it's an FOMC day, we could be in for a bit of a sideways kind of session today. Well, if we don't get a decent signal here soon, I will show you how these tools work. We'll just demo a trade. Crude oil, very, very quiet. All right, we haven't looked at the Falcon yet. This is the Falcon Swing Trader. And normally what we do with the Falcon is we pay very close attention to the trend line. So when the trend line shifts color, we look for actually a signal where everything comes into sync. So you can see the trend line changed color here from red to green to, sorry, red to green. Waffled back and forth, came back, changed from red to green. And right here, we've produced a buy signal where everything is in sync. Took a nice little bounce off of the primary support here, rallied up to the median line. These lines that you see here, by the way, this is what we call a system add-on. It's a standalone tool. You can use it on any chart. It doesn't matter whether it's a time-based chart or a tick chart or pretty much anything except a point and figure chart. And it's an assortment of 21 support and resistance lines for today. The blue line, the gold line, and the other blue line, this is your median line, your primary resistance just above, primary support just beneath, and then we have secondary resistance up here and secondary support down here. Generally speaking, once the market gets above the primary resistance, it tends to be a little bit more bullish. When it gets below primary support, it tends to be a little bit more bearish. Although it looks like we've been sandwiched between the secondary resistance and the primary since the London Open or shortly thereafter. Pretty much skewered right on that resistance line right there. Oh, we might be getting a first micro-macro cross higher. Now, if you're looking for a trade to follow me in on, this may not be the best signal. Why? Well, because we're still very much in a sideways range, but it may give me an opportunity to demonstrate the trade manager to you here. That's this tool here on the right-hand side. Now, the beauty of the trade manager is that it has two very important components. And what I'm going to do is I'm going to delete my profit target and break-even trigger just for a moment so that hopefully I can show you how it manages the stops on the trade. So we've got this particular tool here, and what it does is it helps you control your risk. So no matter where you place your stop, your risk amount is always a constant. That's very important. You don't want to end up risking more than you can afford to lose. Second component is what we refer to as the profit manager. It's an assortment of 16 different stop strategies, and let me show you what those are going to look like. And they're all customizable. All right, so these blue dots here show you how the trade manager would have managed my stops during this trade. And like I say, they're customizable. You can make them looser, you can make them tighter, you can change the oh, okay, that wasn't a very good example. Here, let's go here to parabolics. I don't want to bring this in too quickly, that's why there we go. So you can change, to parabolics. We've got super trend on here. And you can change all your stop strategies to your liking. Now, you see that it was trying to roll up my stop here, so I'm going to disable it for a moment. There we go. Okay, I want to leave my stop down here still. This is actually a red bar buy signal, which tends to be kind of bullish. Also tends to develop near the end of a trend, but I wouldn't say we really have much of a trend here so far. So if we can get up here a little bit, I'll show you how the Trade Manager actually automatically rolls your stops for you. Oh, I know what I can do. I can go with the bar high-low. This is a little bit more of an aggressive strategy, but hopefully it will allow me to show you how the Trade Manager will actually roll your stops for you automatically. The beauty of that is you don't have to monitor this trade any longer. Let's see if we can just get it to tick up for one of the bars. Lee's asking on that support and resistance suite if those are pivot points. Thanks for mentioning that. I forgot to point that out. No, they're not pivots, and they're not Fibonacci retracements. If they happen to coincide, it's really just a coincidence, not by design. Honestly, all modesty aside, I think they're much better. They're much more accurate. Here they are on the soybean market, and you can see soybeans currently pinched right between the primary resistance and the primary support. Still waiting for this to tick up just a little bit, and you'll see the Trade Manager automatically take the stops and start to roll it for you. Come on, give me a break here. Oh, here we go. We're getting warmer. There. All right. So you see how the Trade Manager, it will continue to roll my stops this way according to the stop strategy that I've chosen. The one I've got going right now is rather aggressive. If we're really going to try to ride this one out, I should go with something a little bit more conservative. And of course, you can preview all your stop strategies as well before you apply them. All right, let's go with the parabolics then. So I'll go with the parabolic stop strategy. I can put this trade on the shelf now, and I can look for other opportunities because the Trade Manager will continue to manage this trade for me. Bo asks, which of your three indicators are ideal for day trading crude oil and the NASDAQ? Well, all three, Bo. The reason we have three is because the market environments change. You know, have you ever traded? Well, I'm sure you have. This happens to all of us, right? You have your signal, whatever it may be. You know, moving average crossover or stochastic breakout or whatever it is you're looking at. And some days it works just perfectly, doesn't it? You're taking the signal, you're hitting your profit target, you take your signal, you hit your profit target. And then other days, you can't make it work to save your life. So what's happened? Has your signal changed? No. You're using the same signal day in and day out. What's changed? Well, the underlying market conditions have changed. Problem is, your signal hasn't adjusted to account for the changing market condition. That's why we have three tools. It's not always going to be an ideal trending day. In fact, here on my Eagle Trend Trader, I have this tool here in the top left corner. This is again one of these standalone system add-ons. This is called the trade forecaster. Now, the trade forecaster tries to tell you what the current market condition is and what the next market condition is most likely to be. So right now, trade forecaster says we're in swing mode for about another 20 minutes. After that, we're going to move into scalp mode. Okay, makes sense, right? Because look at what we're seeing here. We're seeing all kinds of crazy sideways action, all kinds of yellow bars here on our scalping tool. And yet our scalping tool so far is the only one that's generated a signal for us. If we were looking, with our trend trading tool, well, we have technically this is a red bar buy signal, but it hasn't flipped over the ATR yet. So we're working on a trend signal, but according to the Eagle Trend Trader, we don't have a trend in play just yet. All right, so we have different tools for different market environments. These tools, by the way, will work on any chart that you can plot on NinjaTrader. And the reason that is because they deal with the underlying market fundamentals of price and demand. Each tool has been designed to pick up its market environment. In other words, this isn't like watching a 5-minute chart for scalping and a 15-minute chart for swing trading and an hourly chart for trend trading. Those are all related, right? A 5-minute chart is only a derivative of a 60-minute chart. These tools, the parameters have been set specifically for scalping, swing trading, and trend trading. So what the hawk uses to determine whether the market is producing a scalp signal is not at all related to what the falcon or eagle use to determine whether we're getting swing signals or trend signals. We have DTS owners who use this system on Forex charts. We have DTS owners who use it to trade the stock market. I prefer the futures market myself. I believe it still to be the purest market out there, the least manipulated, in my opinion. All right, so we're just kind of trying to follow this trade up. Have we hit our profit target? Yeah, so we would have hit our high probability profit target had I left my profit target in. Okay, you guys got some great questions here. Okay, so Lee asks, we always stay on the time frame shown and don't go to a smaller time frame to get a better entry. You see, that's the old way of doing it, right? If you're watching a 5 and 15 an hourly chart trying to gauge the overall market trend, you're watching your hourly chart, right? You're also probably watching a 15-minute chart to get your intermediate signals, and then if you're getting a signal on the 15-minute, you go down to your 5-minute chart to try to get a better price. If we're producing a signal here on the eagle, we're also going to be producing a signal on the falcon and the hawk. That's pretty much a given. But if the market is not trending, we may very well not be getting, well, we won't be getting trend signals, obviously, but we may not be getting swing signals either. However, the conditions for a scalp market are different again, so we may still get scalp signals. So no, we don't normally dial down in the traditional sense, trying to, sneak in a couple of ticks early. We take the signal for what it's worth. If we get a high probability signal, we take that signal. We're more focused on the probabilities. Now, the other thing that I want to mention while it comes to mind is a lot of traders have a production mentality when it comes to trading, right? They think less is more, or sorry, they think more is more. If you're on a production line, the more widgets you produce, the more money you make. So many traders come to the market and they think, okay, you know, I've got to take, I need a signal. I need a signal here. I need another signal. I need another signal. I need another signal. And none of these signals can fail, right? Because that's why I'm losing money, because my signal failed. Sorry, just had to mute the mic there. I had a telemarketer phoning my office here. So people come into the market and they get this production mentality. Oh, I need more signals so I can make more money, right? Because that's how you make more money, by taking more signals. No, it's not. Oh my gosh, I got this telemarketer phoning me back again. I should do what my friend does. She keeps a rape whistle beside the telephone for the telemarketers. Excuse me, I'm going to have to mute the mic until they're done with their annoying message. Okay, I think they caught on that I don't want to talk to them. So what should we be doing then instead? Well, what we should be doing is we should be focusing on high probability signals, and we should be capitalizing on them correctly. So let's take a look here. This is the mini Dow. It's going to do a better job explaining this than the crude oil chart. So where is my high probability signal? Okay, well, we've got one right here. This is a first micro-macro cross signal to the upside. First micro-macro cross. Micro line crosses the macro line, thin one over thick one. It's the first signal where everything is in sync. That tends to be a very high probability signal. So what I want to do is I want to maximize my profitability by not trading more, but by trading more contracts, as many contracts as I can afford. So if I set up the trade this way, I'm going to risk $375. Now that is 2% of my capital. It may look like more or less to you depending on how much money you have to trade with, but for me that's 2%. Now watch what happens when I change my stop. Let's say I put my stop down here. Oop, rounding error. Let's try that again. I'll put my stop right here. Oh, look, the amount doesn't change significantly. It's still, well, 320 versus 375. Still in that neighborhood. It looks like I can risk about up to $400. What if I place my stop way down here? Oh, look, I'm still risking the same amount. But what has changed? Well, the probabilities of the trade have changed, and obviously the quantity has changed. Here I'm trading one contract, and here I was trading, I think, like 5, okay, or 4. But notice the risk amount never changes. The amount that you're risking is constant. So knowing your risk amount never changes, you wouldn't want to strangle your trade, would you? If you're going to risk $360 regardless, would you not keep your stop a little bit further away? I know I would. And by keeping your stop a little further away, you also increase the probability of the trade. Because if I had my stop right here, watch what happens on this trade. Market brings us in. Oh, flinches a little bit. Oh, stops me out for my loss. Remember, that was $360. And then what happens? Oh, it reverses and goes up to my profit target. Now, you may look at this and you may say, oh, well, that's only 50 bucks. I can't make a living on $50. Well, actually, you can. If you traded $50 or for $50 profit just twice a day, and you did that every day, so two $50 trades, that amounts to $20,000 a year trading only a single contract. After that, it becomes a game of math. Not a Game of Thrones, but a game of math. That's the sequel to the Game of Thrones. I'm just showing you here how Trade Manager has brought up my stops before I make the point that if you're making $20,000 a year trading a single contract, quick class, how much money will you make if you're trading 3 contracts? Well, let's see. As you're scrambling for your calculator, 3 times 20,000. Oh yeah, that's $60,000 a year. What if you can afford to trade 5 contracts? That's $100,000 a year. What if you can afford to trade 25 contracts? That's $500,000 a year. You see how this works? It's not trading more. Yeah, I know the high frequency traders do that, but they have tools and access to the markets that we don't. We're not going to make money that way. We're going to make money getting in, getting our $50, getting out, doing it again and again off high probability signals, mind you, not off frequency. Absolutely, Bo. We get this question from time to time. Bo asks, can I use your indicators on a simulated NinjaTrader platform to generate signals while I execute trades on my preferred platform? Absolutely. Yes, we do have traders who will run the system in parallel with their order platform. Although, for convenience sake, I think you're eventually going to end up migrating to NinjaTrader. That's just my experience. I used to do it the same way. I had my broker platform. It's nice being able to enter your trade right on the chart. But to answer your question, short answer, yes. All right, so Lee's asking, didn't the micro cross the macro at 2120, so why wasn't that a high probability trade? Okay, good question, Lee. Let's go back here. He was looking around 2120. Okay, oh, I think I was showing you guys the YM. Here it is on the NASDAQ, and yes, that is a first micro-macro cross. Well done. That's absolutely correct. That's our high probability signal. You can get more than one first micro-macro cross within a trend. First micro-macro cross shows you is a market that has gone out of sync and then a market that's come back into sync. So we have a first micro-macro cross signal here. We have another first micro-macro cross signal here. We have another first micro-macro cross signal here. Bars go out of sync, trend lines go out of sync, filter goes out of sync. Everything comes back into sync. Bars go out of sync, trend lines go out of sync, filter goes out of sync. Everything comes back into sync. So that's what the first micro-macro cross shows you, generally speaking. It only happens as the trend initially changes. So that would be the first micro macro cross. Well, we're plodding along here, trying to test the top end of the trading range, mildly bullish. Oh, there we go. We actually got a little bit of an uptick. Ooh. A little bit of good news coming into the market. Lee asking, do you have high probability stops? Yes, sir, we do. We've got, well, generally speaking, the last swing point is a good high probability stop. Again, that's why we allow the trade manager to manage our risk exposure. So here's the trend change signal on the Falcon that I pointed out earlier. So here's our entry. Where should our stops go? Remember, your risk amount does not change. Where will we know that we're really wrong about this trade? If we put our stops here and the market takes us out, will we know that, yeah, I was wrong? The market's changing direction. No, probably not. DTS is very good at picking up momentum, but sometimes the market will bounce around a little bit. What about here? Okay, that's probably a little bit better, but we've all seen the market, you know, move back and forth, seesaw a little bit, especially when it's trying to change direction. So you may get a premature stop out here as well. Remember, your risk amount stays the same. What about down here? Well, that's probably a lot more significant. We've seen the market respond to this area down here. Obviously, it's responded here and here, so that would be my bet. I would place my stop there. Trade Manager automatically gives me the correct position size, so not only do I maintain my risk exposure, oops, sorry, there's the signal. Not only do I control my risk, but I'm also maximizing my profitability. Oops, sorry, Lee. Lee says, I'm a girl. I thought that after I said that, I thought, oh, Lee's got a unisex name. So we're going with our high probability stop down here. This is where the market would tell me if I get filled at this point and then the market reverses and trades back through here, I can say with a reasonable amount of certainty, yes, I was wrong about this trade. So I want to keep my stops far enough away that I don't get tagged out on the situation. And the further I am able to keep my stops away, the higher the probability of success will be. Intuitively, that should make sense, right? If I can run a very, very deep stop, let's say we're going to do this. We're going to place my stop way, way, way down here. What are the chances? Now we're talking probabilities. What are the chances the market's going to hit my profit target before it hits my stop loss? Probably pretty good. Now again, notice that my risk amount does not change. Very, very important. So we give the market a lot of wiggle room, and sometimes we'll see the market make a little bit of a move like this, and what it will do, it will come down for a little bit, it will retest the low, maybe even break the low just by a tick or two, and then reverse and head higher. Well, once I get this swing, I don't need to leave my stop down here anymore, do I? I can start to bring my stop up, and I can adjust it as the market is going, because after all, if the buyers have dug in here again, then I'm a buyer. I should start to get more aggressive. If they fail and the market reverses on them, and let's say I get stopped out here around 48.20, well, my initial risk may have been 350, and I end up getting tagged for about $100. So if I can afford the 350, I can certainly afford the $100 stop out. It'll be like 3/4 of a percentage point of my risk capital, of my trading account. So that's what we try to do. We try to give the market enough room that it can get to our profit objective. Think of your stop loss as a safety net, right? You're on the high wire. You want to say, all right, if the market trades below X point, let's say it's going to be right here, I'm going to say, no, I'm wrong. I'm going to take my lumps. I'm going to look for another opportunity. But almost without exception, before the market actually gets down here, the buyers will give it one more go. And that will give you an opportunity to roll your stops, especially if you see the, oops, wrong button, especially if you see the market try to reverse on you again. Right? You still get a chance to roll your stop, maybe bring it down here. So your initial risk was here for, say, 350, and you end up getting stopped for, I don't know, $175, $200. Yeah, that's absolutely right. Bo says your risk amount did not change, but your number of contracts will be less. Absolutely. The further your stop is away, the fewer contracts you'll be able to trade. So while your risk does not change, the side of the equation changes. But as I've already pointed out, we're not into frequency. I'm going to share a story with you. I don't think he's in the room this morning, so I'm not going to embarrass him. Oh, I've got an initial D. That might be him. One of our DTS owners, when DTS first launched, he bought a package, a DTS package. And he was always a kind of a onesie-twosie kind of trader. He traded for about 3 years. He made a little, he lost a little. Never really got any traction on his account, however. Then he got the DTS system and he learned about correct position sizing, about controlling his risk. Now, he was a little bit more aggressive than I am on some trades. So what he would do is he would actually start to take trades like this, or perhaps even occasionally take trades like this. And he would start to maximize his profitability. So not only was he containing his risk, but he started to really maximize his profitability. Within a year, he quit his job and started trading full time. Within 2 years, he started trading other people's money. And now he actually trades a fund. And this is only about 3 years. That is how powerful position sizing is. I cannot overemphasize this, and I know those of you who have been in the trading room with me before, sometimes I get off on this tangent, but it's so important. And yet I don't hear anybody talking about it. You know, everybody's talking about signals, everybody's talking about, oh, what are the best settings for my stochastics or RSI or Bollinger Bands or MACD or whatever it is. We're so signal obsessed. Yes, you need a good signal. Don't get me wrong. We spent 9 months refining the signal generation on the DTS tools. These are high quality signal generators. But that's only a part of the equation. The other parts of the equation are, how are you going to manage your trade when you're in it? How are you going to control your risk exposure when you take a trade? Those are all important components. It's like a three-legged stool, right? You're not going to sit on a one-legged stool or even a two-legged stool. You need all three legs of your stool to keep you afloat or keep you from falling over. I'm mixing my metaphors. And yet, like I say, nobody is talking about it. And that's why I call it the best kept secret on Wall Street, because it seems like only professional traders and money managers know how important money management is to your success. This tool that you see here on the right-hand side is, when Adam first told me that he was going to develop this tool, I said, you'll never get it to work for a PC, because this is the kind of tool that the traders down on Wall Street are using. Theirs, admittedly, is much more sophisticated, but it does the exact same thing as what this Trade Manager tool does. Without a doubt, and I'm not saying this lightheartedly, this is perhaps the most important piece of trading software you can own. This tool right here will do more for your trading success than anything else you can do. Now, you can do your own position sizing as well, right? You're going to have to do a little bit of math to figure out, okay, here's my risk exposure, this is what I can afford. Now, by the time you figure it out, the market may already have made its move. That's the beauty of the Trade Manager. It figures it out for you on the fly. But it is ultra important. Like I said, I cannot overemphasize it, and I know I get a little carried away at times. But it's so important. Lee, yes. Lee is asking, as you adjust your stops, does the reward stay the same? Yes, but once your trade goes live, and we've closed out this position now, the market looks like it backed up on me. But once a trade goes live, you can adjust your profit objective. You saw me delete the profit target here early on once I took this trade. When you set up your trade, everything is static. I can't move any of this. But once the trade goes live, yes, you can adjust your stops if you like. Thanks, Tony. Tony reminding me that we got crude inventory coming out in about 15 minutes. Lee also asks, do you always start with a full position, or do you ever add on as the market goes in your direction? Generally speaking, I start with a full position and I cap my risk at about 2%. Normally, anything less than 5% is considered prudent. So if you're trading a smaller account, of course, you're going to be risking a slightly higher percentage. You're going to be leaning toward that 5%. If you're trading a $10,000 account, you're probably going to be risking routinely anywhere from 3 to 5% of your trading capital. If you're trading a $100,000 account or a $300,000 account, well, you only need to risk 1/4% or maybe 0.5%. Right, so it's all relative. But yes, you can add on. When I'm adding on, I'll probably dial down my risk amount to 1%, or I can even go to manual mode. Now, manual mode will default to this amount right here. So I can set up a trade. Manual mode will not contain your risk. Your risk will be what your risk will be. So for instance, if I set my stop or my quantity at 10, I can take a trade down here and risk $1,800 even though I can only afford $350 or $400. But I can dial down my risk amount to 1%, which will effectively contain my risk and still only allow me a single contract. So as this trade progresses, this isn't a trade, by the way, we're just demonstrating here. Oh, and you know what? We'll throw it in. Again, it's not a true trade, so if you're looking for a trade to follow, this probably isn't it. I think we're going to see the market reverse here in a moment. But I want this trade to go live so I can show Lee how you can adjust these things. Come on, get down there, get up there. There we go. Okay, so they're going to bring us in here in a second. Come on. All right, well, once that goes live, I can add additional orders either by hitting the buy market button, or I can right-click on my chart, and I can just place a live order on the chart. Trade Manager will adjust your stops relative to how many orders you add. So let's say it brings me in here and then fills me again on the breakout here and then fills me again up here. Trade Manager will continue to add to my stop loss. So I don't need to worry about having an unprotected trade, an uncovered trade out there. But yes, you can add to it. You can also split up your profit objectives. Normally, especially lately, I've been going all in, all out. So I've got my profit target set at 100%, but let's say I want to go, I'll take a third off at target 1, I'll take a third off at target 2, and then I'll have a third on as a runner. And let's say target 2 is going to be at 20 ticks. And I set up my trade like so. So I've got 5 contracts. Target 1, I take 2. Target 2, I take 2. And that leaves 1 on as a runner. So you can do that as well. No, it's very versatile software. And like I say, you can change this on the fly as well if you get into a trade. You can also manually set targets. A lot of traders I know like to use the support and resistance suite for profit objectives. So let's say, okay, we've got a trend change signal right here. So we're going to click our target. So I'm going to enter here. I'm going to place my stop here. And let's say I'm going to use the second resistance line as my profit objective. I can do that as well. All right, so let's get to the crude inventory. Coming out in a few minutes time here, give me a chance to show you the OCO function. OCO, of course, stands for one cancels other. So we're going to pick a stop. Maybe we'll make it kind of a mid-range stop. All right. So I turn my OCO on. We can see the market's been kind of range-bound here this morning. I right-click on my chart. I place my order, right-click on my chart, place my other order. You see these orders are related. You see how it says OCO1? Well, if I toggle my OCO again, you see the next grouping of orders are marked OCO2. If I cancel the one order, the corresponding order on the other side also cancels. These orders are live when you put them on your chart, so you have to remember that. I tend to put them away and then pull them into where I want them to be. So we'll give them a little bit of room. What I could do, I could even bracket here above the primary resistance and below the primary support. Kind of skewered here. I could make it tighter. You can make it tighter still. Crude oil, of course, tends to be a little whippy at times. So I've got my stop enabled, I've got my OCO order in play. If we get a breakout higher, oh, maybe I should do something, maybe we should be a little crazy here. Maybe we'll go with parabolics, go with something really tight. If we get a really violent breakout one way or the other, the parabolics should stop us out on the first reversal. Now, the thing to bear in mind here, crude inventory reports very, very volatile, or potentially very volatile. Very often you're better off letting the report hit the floor and then bracket the market. When you use the OCO orders, you do not have the advantage of the trade manager, of the risk component here. My risk will be from my entry to wherever the parabolic stop happens to be at that time. And hopefully it won't be that far away. Ken is asking, where's the video on how to use it? Are you asking how to add to contracts, that video? If so, I haven't really done one. However, if I didn't answer your question, just ask me in the trade room. I'll demo it in the trade room. The market's very, very quiet this morning. Not a lot of opportunities for demoing stuff. Should have got on the soybean train here early on. Soybeans, great, great trending market. So we got a nice little trend change signal here. Trend line goes from green to red. First signal where everything's in sync, right? Red trend line, red warning dot, red bars, red filter. Nice little bounce under the median line. Could place your entry just below the primary support. So it would look like this. Enter below the primary support. Can I cover above the high? Oh, I can too. And voila, we just hit our profit objective. So nice little soybean trade. Soybeans, like I say, great trending market. Once they settle on a direction, they tend to stay with it. Okay, the crude oil and the NASDAQ market both very, very sideways, overlapping considerably. And we got about a minute to go. Oh, Ken's asking, video on Trade Manager. Yes, those would be at the Indicator Warehouse site. Indicator Warehouse also has a YouTube channel. So you can watch, there will be a Trade Manager video there. You can also email Adam. And I think I've given you Adam's email, but if not, here it is, if anybody has any questions like that. And of course, we go over it every day in the trade room as well. If there's something specific that you'd need me to show you, ask away. All right, so here it's crude oil now at the bottom end. We're framed almost perfectly within this tight little range. So tempted to bring it in tighter still. I'll give them a few ticks though. I don't trust crude. Not at all. Oh, I should have put a Geiger counter on here. I wasn't thinking. Well, I won't do it now, but I'll show you the Geiger counter after we're done with this. Oh, there they go. Oh. So notice how the trade manager gave me a stop. Now it's automatically rolling it. Come on, get up there. Get up there, you stinking crude market. Oh, come on. Give it a little push with the mouse just to help it out. There we go. Come on, get up there. Got a couple warning dots printing here. Now they're going to try to reverse on me, I think. Trying to check out the bottom end. It's actually a rather subdued open or crude inventory report. Not nearly as violent as we've seen at times. I was mentioning the Geiger counter. Here we are. It's another one of these add-on. Hey, way to go, Tony. I know. Tony says, drat. He says, my OCO was tighter than yours, but Parabolic stopped me out too quick, but I still got a small profit. That's all right. Small profit is better than no profit. So this tool you see right here, this is called the Geiger counter. This is essentially a tape reader. And it gives you a visual of the time in sales. The needle kind of tells you the immediate bias. So you see it went from red to green, or pardon me, red to white, and now it may end up going to green as well. This dial around here shows you the active order flow. And when I try to watch it for, it hops back and forth quite a bit, as you can imagine. There's the crude inventory right there going through. But if we see the dial pull and hold one way or the other, that's a very good indication that we're going to see a lot of buying or selling. Oh, see how it pulled over and it got stuck there for 3 or 4 or 5 seconds? We're going to see a little bit of an uptick here. So we could actually do another OCO order now that we kind of know the limit of the market, the current parameters, so we can buy above that high. Look at how nicely they settled on the support on the median line. Oh, Adam sent me the proper link for that presentation that I mentioned. So you can go there. That's for tomorrow, Thursday. Well, we'll leave that be for now. Put my Geiger counter. There we go. And you can see here on the the hawk, once again, lots of yellow bars. Whenever we get yellow bars printing at more or less the same latitude, we're in chop. We've got a very balanced market. People always asking, Eric, how do you trade chop? Or they really don't care how I trade chop. They say, Eric, how do I trade chop? What do I do? Well, the best course of action when you're trading chop, and again, this is something we go over all the time in the trading room, allow the market to break out, allow it to retest, and then look for that buy signal. Let it break out, let it retest, look for that sell signal. That's the safest way to trade chop. Anytime you try to do anything within this range, you're asking for it. Why? Well, because we've got buyers buying down here, we've got sellers selling up here. Now you can try to do that as well when the market gets down toward the bottom end of the range. You can try to buy it up. You know, even if you bought it here, we're still anticipating at least this little uptick, right? So you may take a little heat on the trade, but there should be some sort of reaction. It's very rare indeed that the market makes a breakout. I'm not even going to be able to show you one here. That the market makes some sort of breakout and doesn't try to react at least once. So you could have said, okay, this is a sideways range, and you try to buy down here somewhere on the breakout. See, even here, the market made a little bit of a reaction. So let's say your stops were down here. You could start to bring your stops up, and then the market reverses and takes you out for a small loss. That's going to happen. But, you know, so long as it's within this range, it's really a very balanced market. Very, very difficult to trade. The best thing to do is just ignore it until it gets outside of that trading range. I know, it's no fun, but there are less expensive hobbies than trading. You need to remember your objective. We're hopefully doing this to make money, not just to amuse ourselves. All right, well, just kind of watching and waiting. Soybeans on a little bit of a tumble still. Crude oil still very sideways. Yeah. Good time to get caught up on your knitting or needlepoint. Tom's asking about the Raptor. Tom, the best thing to do regarding the Raptor is just shoot Adam an email. If you like, he'll give you all the particulars on the Raptor. Dan, yeah. Dan says here on the Eagle we're getting a couple hard edge bounces. Absolutely correctly. Dan? Lee's also got a question here, which I'll get to in just a second. Yeah, we got a red bar buy signal right here, and actually not a bad red bar buy signal. You see the market had kind of this bull flag shape to it. We encountered the hard edge. Remember, whenever we hit the hard edge on the Eagle, we always expect some sort of reaction. If I go back here, okay, when the chart looks like this, no. This is obviously a sideways market. It's not a trending market. This is your Eagle trend trader. That doesn't count. So when you're looking at a chart like that, don't even bother with the Eagle. But you see here, the market's kind of developing a trend. We came down, we hit the hard edge, we produced a red bar buy signal, a little bit of a follow through, a failure. This starts to alert us to the possibility of a trend change. We got the trend change right here. Note, once again, we hit the hard edge, came out, produced a signal. So the hard edge, very important for us when we're trading the Eagle trend trader. We did have a hard edge bounce here. What I was debating was taking it after the ATR turned over or whether I should try to get in early because, of course, we've got these highs to deal with. And it looks as though crude oil also giving us a hard edge bounce on the Eagle right down here. Also a red bar buy, also a high probability signal. The problem I have with crude oil is its affordability. Can I cover it down there? No. See, Trade Manager says, Eric, for risking 2%, you can't afford it not to do that. Lee asks, do you consider gold a high-risk market? No, I don't. In fact, let me put gold up here. I'll load it on my other chart and we'll bring gold over here. Gold is a great day trading market because you can trade it from all time zones. It's literally a popular market around the clock. Now we actually just got a buy signal here on the Falcon. I'm going to pull in my OCO order a little bit. See, we produced a buy signal right here. This is our trend change signal. Trend line changed color. We've got this characteristic little up, down, up pattern, and we produced the buy signal right there. All right, so gold has loaded. Let me bring over a couple gold charts for you. So here's gold on the Hawk. You can see the nice thing about gold, you get some very pronounced follow-throughs on a lot of these signals. And this is gold through the overnight, through the London session. You can see very active. Here's gold during the Asian session. A lot of North American markets, of course, very quiet during the Asian session, and a lot of people who are trading part-time, who are busy during the day, the Asian session is an opportune time for them to trade. However, there's not much going on in most markets. Gold is the exception to that. You can see had a first micro macro cross print right here, took a little bit of heat on it, but it came right back, produced another first micro macro cross signal. Nice on that one. So very easily within the space of an hour and a half, you had two very solid trades in gold. Here's a first micro macro cross lower. Here's a macro pullback signal. The macro pullback occurs when on the hawk scalper, the market retreats to the macro line, and then the micro line goes out of sync, but everything else stays in sync. So that's gold on the hawk. Oh, and I see we got filled here to the short side on our crude oil trades. So we'll just let Trade Manager do its thing there. Here's gold on the Falcon. And same thing, we had a trend change down here, trend change signal. Well, the market just blew through 1, 2, 3, 4, 5 zones. That's a lot. Very strong rally there for gold. Okay, good example of why we have different tools. So we saw on the hawk scalper, we had a scalp signal right about here. Falcon Swing Trader didn't produce one. Even though the market did fall off, have a considerable move to the short side, the conditions were not exactly right to produce a swing signal. And yet we got a scalp signal. Same scenario as what I mentioned earlier. You know, if you have your signal, whatever you're using to enter trades, it works some days, it doesn't work other days. Well, if we only had one tool, we would have missed this move. Because for whatever reason, the Falcon signals were not all in sync, and therefore we didn't produce a short signal on the swing trader. But no matter, we have 3 tools. So regardless of what the market environment is, we're going to catch that signal on one of our tools. It's very rare indeed that we ever get shut out across the board. All right, so here's the Eagle Trend Trader. We got a little trend change signal here. Nice little follow through. A lot of sideways stuff here. You can see gold pretty quiet the last couple of days. Yeah, not much going on there either. 16th, that was what, last Friday. All right, this is a little bit more like it. Nice little reversal here. This is what we refer to as a rule of 3, even though there's only 2 counter trend signals. When the market starts to top out, it's going to make this characteristic, what we refer to as a test of the extreme. In this case, the extreme being the high. And then the market fails. Typically, we will get the Eagle printing 3 counter trend signals, and usually we will go off that 3rd signal. Or we'll use it as an early warning that the trend might be reversing, and we'll look for our trend change signal, which is this one right here. In this case, we only had 2 counter trend signals, but the whole formation itself is still there. Sometimes with the rule of 3, we'll get actually 4 counter trend signals. 5 or 6, I don't consider it a rule of 3 anymore. But typically you'll get 3 counter trend signals and then the market will reverse. But it must always, always, always be preceded by a test of the extreme. So that was a nice little signal there on gold for the Eagle. So, no, I like gold. I like gold a lot. In fact, I should leave gold up there. It's a great market to follow. Oh yeah, Tony, absolutely, 100%. Tony says if a trader ever doubted the power of the Fed, all they'd have to do is look at the chart today. I bet this afternoon session will be a barn burner. Yeah, once the market's obviously waiting on pins and needles for an announcement, and depending on what they choose to do with interest rates and whatnot, whether they're going to continue with their quantitative easing, which I can't see them stopping. It is likely to spur on the market one way or the other. Okay, working a possible trend change signal here on the Falcon, here on the NASDAQ. We're still very, very sideways here on the Hawk. But I can see them probably trying to test the bottom end of the trading range. Maybe even getting into that gap from this morning, which is still below us. Let's see if we can't get at least one trade going here. So a little bit of a downtick, and now they're falling flat again. Well, that's probably a good place as any to leave it. Sure. If anybody else has any questions, please type away. Ying is asking, can you show me that rule of 3 signal again? Okay, now, first off, a rule of 3, we have to have a trend, right? It's a counter trend signal, so you have to have a trend beforehand. That's important to remember. Maybe I'll see one here on crude oil. Oh, crude oil actually in the middle of a rule of 3. So we've got a trend. We've got a market that's in an uptrend, and we're producing sell signals. Well, we're not supposed to be producing sell signals in an uptrend. So I start my count from the first signal. So I would start my count right there. There's signal 1, there's signal 2. Now at this point, I'm starting to get very interested. Why? Well, I've got 2 counter trend signals, and I've got a possible failure. Right? I'm retesting the high. At this time, the market is unable to resume the uptrend. So I've already got all my pieces for a rule of 3. I could put an order to sell. I would probably put my order to sell on a break below this low. If the market is in fact reversing, this bar will print lower, and I will print another sell signal below the hard edge. And that will be my complete rule of 3. Now, if I had, say, a sell signal print back here somewhere, let's say the market came down, broke below, and printed a sell signal down here, I would not count this as part of the rule of 3. The rule of 3 actually unfolds rather quickly. Let's see if I can find you another example. Let's see if I can find you a really good one, like a textbook version. And excuse me if I'm making you guys dizzy here. All right, here we go. So we've got a trend. We've got a downtrend. And now we have a market that appears to be reversing. Why do I say that? Well, because I'm printing signals on the other side of the trading band. There's signal 1, there's signal 2, there's signal 3. Has this market made a retest of the low? Well, yes, it has. It's made a retest right here. It's a relatively shallow retest. Usually I prefer to see something a little bit deeper, but it is still a retest of the low. And from here, we could look to buy and anticipate that the market's going to try to move higher. Now, this move was fairly short-lived, unfortunately, but the concept is still there. Oh, by the way, this is something you'll never see in other trading rooms, a trading room moderator showing you a trade that did not work out. The signals are very good, but they're not 100%, unfortunately. That's a little bit too drawn out. All right, this one is also a rule of 3, even though we only have 2 counter trend signals. Actually, this is a good example. I would not start my count back there. I would start my count right here, and I suppose it makes sense to start counting there because I've got the uptrend, I've got the counter trend signal, and now I've got what is starting to look like a failure. I suspect that this bar was only within a couple of ticks of actually printing another sell signal. That's why we only have 2 counter trend signals here instead of 3. But there's my other counter trend signal. I've already retested the high. The market seems to be failing, and therefore I could either use it as an early warning that a reversal may be coming, or that the market is actually going to change direction. Sure, Permy says, I haven't got it yet. Can you go over it one more time? Sure. All right, I'm going to try to find you one that is crystal clear. A lot of times we'll get like 2 reversals, but let me see if I can find you one where we actually get 3. Crude oil, not very cooperative that way right now. Let's go back to the NASDAQ. Sorry, the market's been so choppy the last few days, I've got to roll back here a little bit to where we've actually had a trend. That one, it is a rule of 3, but it's not what I would call textbook. See all this sideways stuff? Those of you who've been in the trading room with me in the morning know we've been doing a lot of short-term trades. My goodness, how far back here do I have to go? Well, there's a rule of 2. There's a rule of 2. That one's not. All right, you know what? I've saved one here that I was going to turn into a cheat sheet. And let me dig that one up. So we have these cheat sheets, or what we call cheat sheets, to help you identify the signals. So for instance, here on the hawk, these are the 5 high probability signals for the hawk. So here's one for the eagle, and the reason I haven't had one for the eagle for the longest time is I haven't been able to get all the eagle signals in one place? Well, it turns out that a few days ago on crude oil, I actually got all the signals printing in the same spot. So here we have a rule of 3 on the eagle. So we've got a bit of an uptrend. The market comes down, breaks the hard edge, and produces a sell signal. So right now, I'm starting to get a little bit interested. Why? Well, because we're in an uptrend. I'm not supposed to be printing sell signals in an uptrend. So the market rallies off the hard edge, but fails to take out the high. Now I'm really starting to get interested. It starts to trade lower, and it produces a second signal against the trading band. So now we've got 2 sell signals and a failure to regain the uptrend. The market bounces one more time off of the band, comes down and produces a third signal. I now have a complete rule of 3. 1, 2, 3 signals against a bullish trading band. Now, Ying is asking, do you go in after the third signal in the new direction? Very often I will, yes. Especially when it looks like this. The market is screaming at you, we're changing direction. Why? Because look, we can't continue the uptrend. We're making lower swing highs and we're producing sell signals. So this is a very strong rule of 3. If I only had 2 signals, or if the market looked a little bit more sideways, I may wait for the trend change signal, which in this case developed a little bit later. Very often the trend change signal will produce a little bit earlier, a little bit up here. But yes, definitely, you can hop in right after the third signal. Yes, exactly. Lee asks, so the 3 failures to go higher makes it an especially good sell? Yes, absolutely. Because remember what you're seeing here. We've found obvious support. There's obvious buying going on here, right? The market rallies up. Sellers got busy early. Last time sellers got busy up here around 46.55. Now they're shorting 46.50. Market comes down. Okay, the buyer said, well, we're having none of that. We'll buy up at 46.10. They buy it up and the sellers say, oh, no, you don't. We're going to knock you down at 46.40. So now it comes back here to 46.10. The ball is in the buyer's court and they fumble. And I'm mixing my metaphors again, my sports metaphors. And down they go. And part of the reason this move was so pronounced is the buyers who bought here had to ditch, the buyers who bought here had to ditch. And then there was a little bit of a late reaction, some late buying, trying to scramble, get the market back up, so maybe they could get out of break even. Well, guess what? That's what happened here. The traders that were buying somewhere around here, they couldn't quite get break even, but they got what they figured they could before the sellers overwhelmed them again and pushed the market down one more time. So that's what happens all the time in the marketplace. That's why I really appreciate these mean Renko bars that come standard with DTS. You can actually use DTS on tick charts and time charts as well, but you really get to see who is controlling the market. So I was actually waiting for this first micro macro cross. I was going to mention before I was looking at that rule of 3 that we may see a sell-off here in the NASDAQ, or maybe I did mention. But we've got a market making a push higher, it comes down. It comes up higher, but it fails. And all of a sudden it comes down and produces a sell signal. There's a very good chance we will at least see a short-term move lower. This is very difficult to interpret because there's so much choppiness, but you can see the support is holding, support is holding, support is holding. Oh, all of a sudden we get higher support. Now we get a buy signal. There's going to be at least a short-term move higher. Market goes up, it comes down, goes up. Oh, it fails to go higher. Well, we're probably going to see a poke lower. Here's a sell signal lower. And there's a chance for the market to move a little lower. Lewis asks, do any of these indicators use order flow or market or volume profile levels? Not per se. There are price characteristics programmed into the indicators. There's also volume and momentum parameters that have to be met, but not in the traditional sense of volume profile or market profile. One thing I should point out is on the DTS system, it's been designed to be easy to use. Now I know looking at a day like today, it doesn't look very easy. Normally it's not like that. But it only presents you with a limited amount of information so that you can make a decision. Personally, I think the ability to make a decision is one of the most important attributes you can have as a trader. A lot of traders, and you may have suffered from this yourself, the whole analysis paralysis scenario, right? You get too much information, you can't make a decision. This is one of our charts from one of the traders who came to us. He was watching all these different things trying to make a trading decision. Well, how in the world do you make a trading decision from that? Right? There's just too much stuff on your chart. Versus something like this. Oh, trend line changes color, everything is in sync. Here's my buy signal, and I can go ahead and take that buy signal. That does not mean, however, that this is all that's going on. There's actually about a half a dozen parameters that have to be met working in the background. There's about a half a dozen algorithms that have to be satisfied before you even print a warning dot. So there's a lot going on behind the scenes with each of these tools. It's not just what you see on the screen here. There's a lot more stuff going on in the background. And it looks like they're going to try to get into that morning gap after all. So we're starting to see a little bit of a move lower now. Ken's asking what's in the filters. Well, it varies from tool to tool. Very often the filters will have some sort of momentum component to it. But it does vary between the different birds. All right, if there are no other questions, I think we're going to close up the room today. And DTS owners, I will see you in the trading room again tomorrow morning. We will have another open house next Wednesday, so I hope you'll join us then. And don't forget about the webinar that we're doing tomorrow. If you have the time, I'd love to see you guys there. It's always more fun doing these presentations when people are in attendance. And it's the information we're providing is universal. You know, a lot of these webinars that people put on, they just put them on for the sake of demonstrating their software or selling whatever it is they're selling. But tomorrow's webinar universal content, something that will help you regardless of whether you choose to get the DTS system or not. All right. On that note, we'll close things up. Thank you again for your attendance, and I hope to see you guys tomorrow. Bye for now.